Lifting of relaxations and pickup in the economic activities have led to a sequential recovery in most segments in the Q2 earnings of GAIL. In our ideas for profit today, we'll discuss whether this stock merits investors' attention despite having run up quite sharply already. Well, post a subdued Q1, the performance in Q2 was noticeably better. Now, if you see hit by lockdowns, GAIL's Q1 performance was weak, and that was mainly due to lower volumes and also the price realizations. Now, the company's petchem business have seen a major rebound, a turnaround, and with the plant operations going back to now normal utilization levels, say of around 107%. Now, there was a 65% jump in the volumes to 221 MMT as you compare it with Q1. Now, with better utilization and price realizations, the segment profitability also improved and EBITDA was at 170 crore rupees during the quarter. Now, gas transmission business saw a 21% sequential uptick in the revenue, and that was on the back of an 18% surge in the volumes that were seen and a 13% improvement in the price realizations as well. However, compared to Q2 of FY20, the volumes were down 2%. Also, the improvement in gas demand has led to a 9% sequential volume uptake in the gas trading business per se. Now, the segment reported an operating loss of say 400 crore rupees as well. Now, the Kochi-Mangalore pipeline work has further got delayed and is now expected to get completed by the end of say November of 2020. Now, lockdowns had impacted the work at various upcoming pipelines also, and the timelines over there also have got extended. Now, with the lockdown being relaxed now, the work is slowly and gradually picking up, and taking cues from the management commentary, we do expect that GAIL's volume will actually see a decent growth in FY22. Now, the commissioning work at the Ramagundam fertilizer plant is going on right now, and an additional volume of around 1.5 CMD, if you see, that is expected post the December 2020 month. Now, apart from this commissioning of the Gorakhpur, Sindri and Barauni fertilizer plants as well, and also the refineries that are connected to the Urja Ganga plant, that will all contribute to an additional 11 MMS CMD of volumes as well going on from here on. Now, there have been indications by the management already about the considering of a subsidiary model to separate the gas transmission and also the marketing businesses from here on. However, the same has not been approved by the board as of yet, and the contours are also not decided. Now, a split in the business could actually lead to some value unlocking for the company, and that should work for the stock also going forward. So, what's next for the expensive US LNG cargoes? Well, GAIL has around 5.8 MMT in US LNG contracts. With a dip in the spot LNG prices, these US cargoes are right now quite expensive. GAIL sells around 40% of this volume in the international market and around 60% in the domestic market in India now. Nearly 70% of these cargoes are hedged, according to the company. Also, if you see, around 90% of these imports are already tied up in the long-term contracts as well. Now, GAIL received 20 US LNG cargoes in Q2 as you compare it with the 21 cargoes that were received in Q1. Now, majority of these were sold in the international markets. Now, with an uptick in the domestic demand post the commissioning of planned pipelines, if you see, GAIL really expects around 15 MMS CMD of additional demand, which definitely should help in placing these US cargoes going forward from here. Now, the company has planned around 5,000 crore rupees of capex in FY21 and 6,000 crore rupees of capex for FY22. The management has also highlighted that while the capex was impacted in H1 due to lockdown, the company really plans to accelerate the progress in this space in the second half of the year. Now, the board has also approved a borrowing plan for up to 10,000 crore rupees in one or more tranches. So that also is going to give additional liquidity to the company for all these things. Now, the company's current debt to equity ratio is 0.19 times, which could see slight increase. However, would definitely remain in a manageable range. Now, following the demand growth, the company should actually find scope for even improving the realizations, which should definitely help in the margin improvement going on from here, and quite gradually though. Now, given the relatively higher retail prices of say petrol and diesel and also of the industrial fluids, we do expect demand for the gases to actually recover quite rapidly. Lower natural gas cost is a positive for both the transmission as well as the petchem segment. The CNG volumes are currently affected, but definitely a gradual recovery in line with the increase in the vehicular traffic as and when the lockdown opens further will be seen. Now, the stock has seen correction and definitely is trading at FY22 estimated PE of 4.6 times, which is much lower than the long-term multiples. Thus, this has made the stock an attractive bet at the current valuations.